or 5 short questions, they make one long question. And we will take time because I actually always explain consolidation through questions. While doing questions, I give explanation. I don't believe in showing the slides or PPT for consolidation. That's not the good way. The best way for doing consolidation is pick up a question and start explaining. So I'll read with you. You have to be patient. I don't want to do 20 questions. I want to do 5, but I want to explain the concept while doing questions.
Okay.
So it says that which company acquired 70% of the 200,000 equity shares of Visit. So I immediately make up in my mind, I'm making a picture that it is a 70% ownership control is there. So 140,000 shares they purchased. Okay, 140,000. It's only subsidiary. And this is also important that this is the only subsidiary. Why do they tell us? Always remember, I say that the answer lies within the question. They give you some clue. They could have told us that which company acquired 70% equity shares in Visit. And that's all. Why do they say it is only subsidiary? So let's see. On 1st April, I mean, this information looks to me either irrelevant or very crucial. On 1st April 2008, when the retained earnings of Visit Company were 450. So at the date of acquisition, Visit Company had retained earning of 450,000. So Visit Company had 200,000 equity shares, probably at $1. We will check. Plus, they have retained earnings on the balance sheet. So equity, you remember, consists of share capital share and the retained earning. The carrying amount of Visit Company's net asset at the date of acquisition were equal to their fair values. Now, that was also a concept explained in the F3 lecture. If you had watched it, you would understand. Which company measures non-controlling interest at fair value based on share price? The market value of the Visit Company at the date of acquisition was 1.715. Okay, it says that the value of the non-controlling interest is at 70%. At 31st March 2009, the retained earnings of Visit Company were 750,000. At what amount should the non-controlling interest appear in the consolidated statement of financial position of which company? So, at what amount it should appear? So they are giving you, you have to find out the non-controlling interest NCI at the closing date. You should pay attention. So the acquisition happened on 1st April 2008, and you're asking non-controlling interest, which is also called minority interest. So what happened? There's a lot of information which is not needed. Very honestly speaking, they have given most of the information is irrelevant. If we had read the requirement in the beginning, probably I would have skipped. But it's also good to explain. So what they ask you here, first you understand the requirement is they ask you that non-controlling interest at the reporting date. So that is very important. The first thing is that when you purchase 70% of shares, somebody else purchased 30%. That somebody else who owns 30% is called non-controlling interest. When you purchased 70%, you paid some money. How much? That is a different, you paid, that was a different case. We are not interested. We are only interested that how much this NCI paid. So we say that there are two, non-controlling interest is a third party who has minority interest, who has shares less than 50%. So there are two values. One is called non-controlling interest at acquisition. Like on the date of acquisition, when this business was purchased, how much was the non-controlling interest? So they give you, it said that, if I read the question, it says which company measures non-controlling interest at fair value based on the share price. So you measure the value of non-controlling interest at fair value based on the share price. So how many shares NCI had? This non-controlling interest, it had shares 200,000 into 30%. This is their shares, right? Because the total number of shares are 200,000, and out of 200,000, 30% they belong to NCI. And what is the market value on that date? When acquisition happened, the market value of the shares, it is given here 1.75. It is given 1.75. So this is how you value them. You say it is 1.75. So this is what I give the value, which means that when this business was acquired, at the date of acquisition, 1st April 2008, the non-controlling interest was valued at 105,000. Okay, it is 105,000. This is the value of NCI, but you call it value of NCI at acquisition. You call it acquisition. Why do I call it acquisition? Means on the date of acquisition. On the date of acquisition. Now we need to find out the value at the reporting date. How much is the value of the NCI at the reporting date? Reporting date means 1 year later. Acquisition happened on 1st April 2008. You need to find out at reporting date. Reporting date means the date of preparing the financial statements, and that date is 1 year later. It is 1 year later. What do you add? So if NCI comes in, when we together purchase the company, he paid 105,000. 1 year we did business together. End of the year, his value should be more. Something should be added. It should be 105,000 plus something else, because 105,000 NCI invested from his pocket. After 1 year of business activity, he expects something more than 105,000. 105,000 I invested myself. Then I worked in the company. The business made some profits, and I need something my share. So you say non-controlling interest at reporting date is always equal to NCI at acquisition. We call it NCI, non-controlling interest, plus NCI's share in post-acquisition retained earning of Visit. So this Visit company, it made some profits. So whatever profits it made after acquisition, which means after the reporting date, within those profits, 30% belongs to the parent, this NCI. So how much profit they made? When you got the company, the retained earnings were 450,000. After 1 year, the retained earnings are 750,000. So it means that there is an increase in the retained earning. There is some increase in the profits, retained profits. 30% of that belongs to the NCI. 30%. You would say that 100,000, which I'm actually taking like this, I would say 450,000 minus, 750,000 minus 450,000 multiplied by 30%. This is what should you give to NCI. And you make it equals to sign. And then you can make a total. Actually, this is F3 level question. When you will go back to your F3, you would see that there are 5, 6, or 7 questions like this. And I explained them in more detail in F3. Here, I'm just going a little bit fast. But in F3, if you watch this, you would understand it much better. It's a very typical F3 question. So 195,000 is the value. I will explain you what is 195. Listen, there was a company, Visit, which was sold. 2 people purchased. Which company was one owner? And NCI, the third party, is another owner. He pays 30%. He bought 30%. For 30%, he paid 105. And this happened on 01/04/2008. Then the business continues its activity. So they're now asking us on 31st March 2009, 1 year later, how much this value should be. It cannot be 105. 105 was at the beginning of the year. If you call NCI and say, listen, you take your money, you go out. How much do you want? Take your 105,000, you go out. He would say, listen, 105,000 I gave from my pocket 1 year ago. The business made some profit. Give me my share from the profit. So this is his share from the profit. The money which he invested plus the profit which belongs to him. So this is actually, I took a lot of time. It was easy question, but I probably took more time on that. So 232, cloud company. Okay, let's first read the question. It says, what was the total consideration paid for cloud company's share company of Mist company? What is the total consideration paid for cloud company's share of Mist company? Which means how much cloud paid for Mist company. So cloud company obtained 60% of the holding in the $100,000 one equity shares of Mist on 1st January 2008. Cloud company paid $240,000. Now listen, consideration means the price which you pay. And consideration, there are 4 types of consideration. Consideration can be paid in form of cash. Consideration can be paid in form of share exchange. Like you don't pay cash, or probably you pay some cash, but you also give your own shares. You call it share exchange. Then you have deferred consideration. Okay. Deferred consideration. Deferred consideration means that we agree on a price of 5 million, and I say that I give you 4 million now, and I give you 1 million after 2 years, okay, or after 1 year. So that is called deferred consideration. You promise the money, but you say I will pay after some time. And what you need to do, you must discount the deferred consideration. Okay, always remember you have to discount the deferred consideration. They give you in question that discount rate is 10%. So then what you should write down for deferred consideration, you should say 100,000 divided by 1.1. Like you are discounting it. You are finding the present value, which is 100,000 divided by 1.1. 90,000 you should write down in your books, because you promised to pay 100K, but you would pay it after 1 year. So today, this is liability is only 90,000. So you should remember that whenever you have deferred consideration, which you promise to pay in future, you must discount it. The 4th type of consideration is called contingent consideration. And you should remember that contingent means conditional. Conditional means that, you agree on something that, because there is always a debate on the price. The seller says, my business is making a lot of profit. I need $10 million. And you say that your business is not making as much profit as you are saying. So we don't accept 10 million. We will only give you 8 million. There's always a bargain. And then what happens? That you put a condition that, okay, let's suppose if your business makes profit like you say, if you reach certain targets, I will give you some extra money after 2 years. So contingent consideration is not a firm commitment. It is a conditional commitment. Like if the business makes certain profit level, I will give $1 million more. So it's not my liability. That's a provision. That's a provision. You have to create provision for this. But deferred consideration is your liability, because you already have promised that I will give you 1 million regardless of the results. So it is not dependent or conditional. And cash I give now, and shares I also give now. So 2 things you give now, cash or share exchange, and 2 things could be promises for future: deferred consideration or contingent consideration. So anyways, we just explained you some terms. So it says that now we have to find out how much cloud company has paid. So cloud company paid 250 cash immediately. Very good. And with an additional 400,000 payable on 1st January 2009. It is happening 1st January 2008. So that is called deferred consideration, because they are making a promise that they will pay exactly 400,000 after 1 year. It's not contingent, it is deferred. And 1 share in cloud for each 2 shares acquired. Okay. For every 2 shares you are buying, you are giving 1 more share from your side. Cloud company has a cost of capital of 8%. We will discount it. And the market value of its share is $2.30. Very simple question, very easy question. We will do like this. Okay, let's start putting numbers. You've got cash. How much cash you paid? You paid 250,000. That comes straight. Then you say, I will make my deferred consideration, which is how much you promised. You promised deferred consideration of 400,000, but you would pay it after 1 year, and your discount rate is 8%. So you divide it with 8%. So this is your present value of your deferred consideration. 8%, we discounted it. So this is done. And then you have a share exchange. And how are you giving the shares? Now let me clear it again. It says that they are making 2 shares acquired, 1 share in cloud for every 2 shares acquired. So for every 2 shares, you are giving 1. So how many shares are there? So the total number of shares are 100,000. From 100,000, we are buying 60% of the shares, which means we are buying 60,000 shares. And for every 2 shares, we give 1. So you have to multiply it 1 divided by 2. 1 divided by 2 means that for every 2 shares, you will issue 1. So by the way, this number, how much this number will come, I will show you here. You will issue 30,000 shares in your own company, cloud company, because you are buying 60% of 100,000 shares. So you are buying 60,000 shares in Mist. And you said for every 2, I will give 1. So it means you are going to give 30,000. But what is the value of each share? They say that the value of the share was 2.30. So I also give them this 30,000 shares at 2.30. So you just put it here, and I put the equals to sign. So 69, actually the 69,000 means 30,000 times 2.3, because I'm giving 30,000 share. Each share is $2.3. Okay. So then you make a total. This is your answer actually. 689,370. 689,370. This is the total value for consideration which has been given by cloud company. So cloud company acquired 60%, and to get 60%, they actually have paid 689,370, which consists of cash, deferred consideration, and the share exchange. Answer should be answer option A. So now this is 233. And again, let's first read the requirement. What does it say? It says, what effect will any adjustment required in respect of the property have on group retained earnings at the 30th September 2001? Group retained earnings, what will happen? On 1st June 2001, Premier Company acquired 80% of the equity share capital of Sanford. At the date of acquisition, the fair value of Sanford Company's net assets were equal to their carrying amounts, with the exception of its property. This had a fair value of 1.2 million below its carrying amount. The property had a remaining useful life of 8 years. Okay, now that is actually a question they have given you. I didn't like it. They should have given you first a question which says above. First, they should teach you above, and then they should come down to below. Just like first we tell people how to multiply, then we teach divide. First we tell how to add, and then when students they understand add, then we teach subtract. If we start teaching from divide, it's not a good idea. Similarly, I don't like it. It is to be below. Please pay attention. I'm going to spend some time on that. And first I will explain you the concept of above, and what is fair value, how does it, what type of impact it has, and then I will do this question. So I'm not doing 233 now. I'm first explaining the concept. Okay, what happens? There is a parent and there is a subsidiary. Parent has purchased subsidiary. Subsidiary has non-current assets. Okay, parent also has non-current assets. Parent has non-current assets of, let's call it 500,000, and subsidiary has a non-current assets of 300,000, or let's call it 200,000. When the parent acquires, now what happens? It is possible that parent has a different accounting policy. Parent is measuring the fair value, the assets at fair value. Okay, parent is measuring the asset at the fair value, which means the market value, whereas the subsidiary is doing the cost model, which is the net book value. It is possible. Now I cannot tell my subsidiary to change their accounting policy. That's a separate company. That's a different company. So they are showing their non-current assets 200,000, but they measure it at, how to say, the book value, the net book value, whereas I'm doing as a parent at fair value. So what happens when I do consolidation? I need to make fair value adjustment. I find out what is the fair value. Somehow I realize that their fair value is 230,000. So if the fair value is 230,000, it means that this company did not record that 30,000 of revaluation gain. So there is a 30,000 of fair value adjustment. Okay, we call it fair value adjustment. And what this fair value adjustment will do? The fair value adjustment will have impact on 2-3 things. Number one, it will fair value adjustment. What it will do? Fair value adjustment when it is upward. When it is upward, I'm not telling below now. If you adjust the fair value, the first effect is goodwill will go down. Goodwill will decrease. This is the first impact. Why? By the way, again, this I explained in F3 video. If you watch F3 video, you will understand this concept again in a question format. Here I'm explaining you as a concept. It's question you would see in F3 video. Goodwill will decrease. Why goodwill will decrease? Because if you remember the goodwill formula was, consideration minus the net assets. And you know that what is net asset? Net asset is equity. Net asset, actually, I told you that it is just equity. So let's suppose that you were finding goodwill. You paid consideration of 13. You paid consideration of, I don't know. Let's suppose 1,000, and the net assets were 700. So your goodwill, let's suppose your goodwill is equal to 300. Now, if you make a $30 fair value adjustment, what will happen? That this will increase the net assets, because revaluation reserve, this fair value increase means that it is a revaluation reserve. The property value goes up, so revaluation, it will go up. So the revaluation reserve is part of equity. So naturally speaking, after fair value adjustment, the net assets will not remain 700, they will become 730. And when they become 730, so this will become 270. So in a very simple way, an upward fair value revaluation, upward fair value will increase the net assets and increase the net assets of subsidiary, and increasing in net asset means decrease of goodwill. So this is the first impact. The second impact is subsidiary profits will decrease. Subsidiary profit will be decreased, or you can call it subsidiary retained earning. Let me call it profit, or let me call it retained earnings. Okay, will decrease. Why they will decrease? Because subsidiary was charging a depreciation of only 20,000. Okay, because subsidiary thought that its assets were 200,000, and they were charging, let's suppose, 20% of 200,000. So what subsidiary was charging depreciation was 200,000 into 20%. Okay, this much depreciation they were charging. They were charging a depreciation of 20,000 into 20%, and 20,000 into 20%. It means that they were charging a depreciation of 4,000. But parent knows that asset. I'm sorry, it is not 20,000. It is 200,000. 200,000 of 20%. 20%. So they were charging a $40,000 depreciation. But parent. So I will write down subsidiary. Subsidiary charged depreciation. Parent calculates depreciation. Parent will calculate depreciation in a different way. Parent will say that their assets are not 200, it is 230,000 into 20%. So according to parent, the depreciation should be more. Okay, so 46,000, and the difference of these two, it will decrease the profit of subsidiary. So this is the second adjustment you should remember. Whenever you do consolidation fair value adjustment means that when you revalue the non-current assets of the subsidiary, it will have impact on goodwill, and upward revaluation will decrease the goodwill. I explained why, because upward revaluation means net assets will go up. Net assets will go up means goodwill will go down. And the second adjustment is on the profits of subsidiary, because subsidiary was charging depreciation on a smaller amount, but parent will calculate depreciation on a bigger amount, and therefore subsidiary retained earnings will decrease by 6,000. There's a third adjustment which you will call, and third adjustment will be group non-current assets will increase. Group non-current assets will increase. How they will increase? Group will say parent non-current asset 500,000 plus subsidiary balance sheet assets 200,000 plus revaluation of 30,000. So you will add this 30,000 also. So the total assets will become 730,000. I mean, if you see the balance sheet, they are only 500 plus 200, 700. But in the consolidation thing, it will go as 730,000. So these are the three very important adjustments for revaluation, which you call fair value measurement upward. And now we come back to our question here. Now this is upward thing. Okay. Now in this particular question, they are saying below. When they say below, you have to go opposite of that, because they ask us, what effect will any adjustment required in respect of the property have on group retained earning? How much group retained earning will go down? Now you remember that group retained earning will go down by this number, the depreciation effect, because the group retained earning, and will they go up or go down? They should go up, because when you did upward revaluation, your depreciation became more and profits become less. If you want, I can write down like this so that you don't forget. Upward revaluation, what it will do? It will increase value of asset, increase depreciation, and as a result, decrease profits. So this is the case of upward revaluation, that your profits ultimately will decrease. Let me make it a bold, because these are the rules which you have to remember. I'm sure you understand. But when you do it downward revaluation, downward, like in our question, a downward revaluation means decrease in value of assets, which means decrease depreciation, and decrease depreciation means increase in profits. So this is what you should remember. First, you understand the logic. Numbers we always calculate later. I mean, you can only calculate numbers when you understand what you are doing.
Yeah.
Okay, so we understand in this particular question, they told us that it's a downward revaluation. If it's a downward revaluation, our profits are going to increase. And we know that profits are going to increase because of the change in the depreciation, because of the depreciation amount. So how much is the depreciation, or how much is the change in the value? So they say that it had a value of 1.2 million below. Just like I increased 30,000 upward, now you are decreasing 1.2 million. So this is the amount which you have to consider. Okay, so it would be 1.2 million. Let me write down like this, 1.2 million. And what is the life of the asset? How should I calculate depreciation? It says that the property had a remaining useful life of 8 years divided by 8. So this is 1 year depreciation. So if I put here 1 year depreciation, the answer would be 150,000, which is not correct. This is not correct. Why it is not correct? Because you need to pay attention to the dates now. Please pay attention to the dates. When did you acquire the company? You acquired the company on 1st June 2001. When are you preparing financial statements? You are preparing on 30th September 2001. So it means June, July, August, and September. You should be calculating depreciation. Like when I divided with 8, it is full 1 year. You should be doing it multiplied by 4 divided by 12. Okay. You should calculate 4 months depreciation. So how much is the 4 months depreciation? The 4 months depreciation is 50,000. 50,000. And now this is the change in the depreciation 50,000. But there is one more complication. The question says that effect in respect to the property have on group retained earning. Group, which means the parent. The parent only owns 80% of that. See, the total impact is 50,000. But out of this total impact, I would say that belongs to parent. How much belongs to parent? What belongs to parent is just 80%. So 50,000 is the total increase in profit. Increase in profit will be 50,000, but to the parent, it is only 40,000. So your answer should be 40,000. 40,000, you would say that the group retained earnings will increase. The group retained earnings will increase by 40,000. Why? I'll go back again because now I'm going to make a summary of this. There is an impairment loss, or you call it downward revaluation. Because of downward revaluation, depreciation will decrease. When depreciation will decrease, profits will go up. So one thing we understand that profits will increase. That is for sure. Now, what would be the amount of profit, change in profit? We say, what is the decrease in the value? It is 1.2 million. And 1.2 million had a life of 8 years. So we divide it with 8, but then we need to calculate only for 4 months. And we take 4 months out of that. This comes the total impact. The total impact is 50,000. But out of 50,000, what belongs to the group? Because the remaining 10,000, 10,000, it will go to NCI. This 10,000 you will give to NCI. So 40,000 will be charged to parent, which means it will be an increase in profit to the parent, and 10,000 benefit or increase in profit will happen to NCI because 20% will go to NCI.